Good morning. Thank you for joining Mayer Brown's Global Financial Markets teleconference series. Today's call is entitled The CFPB Looking Back and Ahead. My name is Ori Lev, and I'm a partner in Mayer Brown's Washington, D.C. office and a member of our Financial Services Regulatory and Enforcement practice. I represent financial institutions and other companies in government enforcement matters, internal investigations and litigation, and provide regulatory advice and counsel on federal consumer financial and economic sanctions law. First, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again or forward it to your colleagues. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we will not have a Q&A session, please send your questions regarding today's topic by email to gfm@mayerbrown.com, and we will respond promptly. This is the same email address on your invitation email. Joining me today is Mayer Brown partner Stephanie Robinson. Stephanie is also a partner in our Washington, D.C. office and a member of our Consumer Financial Services Group. She focuses her practice on a range of matters related to mortgage banking and consumer finance in both the primary and secondary markets, representing banks, mortgage lenders and servicers, and consumer finance companies in enforcement proceedings before U.S. federal and state agencies. With that brief introduction, we will now begin today's discussion. We're going to start with a discussion of CFPB Director nominee Rohit Chopra's confirmation hearing, which was held last week. If we had to sum it up in one word, it would be uneventful. Those expecting fireworks or hard-charging attacks on the CFPB were likely disappointed, though a few Republican senators did express their concerns with the agency's past practices and structure. A few themes, however, did emerge. Commissioner Chopra reiterated his views that monetary remedies are critical in enforcement actions, noting that while at the FTC he pushed back hard against what he called, quote, no-cost settlements, and that it, quote, just does not make sense when you rip someone off and don't have to pay them back. This was not surprising given Commissioner Chopra's past statements at the FTC, and we expect to see an increased emphasis on monetary remedies in CFPB enforcement actions, both consumer restitution and civil money penalties. Commissioner Chopra was also asked several times about the importance of providing clear rules of the road to industry. He diplomatically answered that it's important that companies understand what the law requires, but he did not commit to undertaking rulemaking to define abusive practices, stating instead that the CFPB needs to enforce the law as written by following Congress's language and being subject to judicial scrutiny. His answers in this regard and his past record at the FTC suggest that the CFPB will not hesitate to use its abusiveness authority and will not hesitate to do so even in contested matters. Substantive issues that came up frequently at the hearing included protections for service members and student loan borrowers and an emphasis on fair lending. On the latter, in response to a question from Senator Warren, Commissioner Chopra criticized not only the CFPB's decision to strip its Fair Lending Office of a role in enforcement matters, but also the FTC, noting that the FTC, in his words, quote, did not file a single enforcement action under the Equal Credit Opportunity Act for years and years. This was one of just several instances in which Commissioner Chopra criticized the agency where he currently serves as one of 5 commissioners. In any event, it's clear that fair lending is likely to be a key priority of the CFPBs in the years to come. One other substantive issue worth noting is Commissioner Chopra's repeated references to big tech companies and big data aggregation. Indeed, when asked what he thought the most significant developments in consumer finance were that posed new risks to consumers, Commissioner Chopra talked about mass data collection, its impact on privacy and the security of data, and about the use of algorithmic decision-making. Mr. Chopra is clearly focused on big tech and big data, and it will be interesting to see how that translates into action at the CFPB, whose general privacy jurisdiction is more constrained than that of the FTC. With that, I'll turn it over to Stephanie to address some recent developments under Acting Director Dave Uejio.
Thanks, Ori. So, as the Acting Director has said at least a few times now, he has 2 top priorities for the CFPB. The first is relief for consumers facing hardship due to COVID-19 and the related economic crisis. And the second is racial equity, so fair lending, as you mentioned. So as an acting director, he has been especially prolific since assuming his role just a few weeks ago in the end of January. He has already issued statements conveying his broad visions for CEFL, for the Bureau's Division of Research, Markets, and Regulations, which is referred to as RMR, and then also for the Division of Consumer Education and External Affairs. So some of the things he's talked about in those statements, one is directing CEFL through its supervisory examinations to make sure that any issues that it finds are corrected, including requiring supervised institutions to remediate all harmed consumers and to change the practices at issue to address the root causes of harms that they're finding. And he specifically noted that in some cases, penalties may be necessary. He also has vowed to expand investigations and exams to ensure that the CFPB has what he calls a healthy docket intended to address racial equity. So again, indicating that fair lending enforcement is a top priority. As far as the Division of Consumer Education and External Affairs, he said he wants this division to redouble its efforts to ensure the Bureau engages with all consumers who are economically suffering, targeting the Bureau's resources to reach homeowners who are either in delinquency or at risk of foreclosure, as well as renters who are at risk of eviction. And then, among other things, he directed RMR last month to focus its efforts on averting, to the extent possible, a foreclosure crisis once the COVID-19 forbearances end this spring. And he also asked them to explore options for preserving the status quo with respect to QM and debt collection rules. And he specifically asked that in any policy proposals, they include the racial equity impact of the policy intervention. So, Uri, I'll turn it back to you now to cover enforcement.
Thanks, Stephanie. We wanted to cover three general areas regarding enforcement today. First is notable enforcement actions that were brought by the CFPB under Kathy Kraninger toward the end of her tenure. Wanted to talk a little bit about what we can expect from Commissioner Chopra if and when he is confirmed. And then finally, just briefly touch on the two enforcement actions that the CFPB has brought since the inauguration under Acting Director Uejio. In Director Kraninger's last year in office, the CFPB filed nearly 50 enforcement actions, which is the second highest total in the agency's 10-year history. Some of the notable actions that were filed toward the end of Kraninger's tenure are the following. First, there were two actions against auto loan servicers. One focused on various servicing practices that the CFPB found to be unfair or deceptive, including wrongfully repossessing vehicles after consumers made payments sufficient to stop repossession, keeping consumers' personal property in repossessed vehicles until the consumers paid a storage fee to retrieve it, failing to inform consumers of payment options that would have incurred lower fees, and misrepresenting loan agreements' impacts on consumers' bankruptcy protections. This servicer was ordered to pay $1 million in consumer redress to those whose vehicles were wrongly repossessed and a $4 million civil money penalty. The second auto loan servicing settlement focused exclusively on credit furnishing violations and found that the servicer failed to establish and implement reasonable written policies and procedures regarding the accuracy of information it reported to credit bureaus as required by Regulation V, in that it reported inaccurate information, failed to correct it, and failed to report the date of first delinquency on certain delinquent accounts. This servicer was required to pay a $4.75 million civil money penalty. The CFPB also brought two separate actions against companies that provide a service whereby consumers can make biweekly as opposed to monthly payments on their auto loans to accelerate their loan repayment and save on total interest costs. In both cases, the CFPB alleged that the savings advertised by the companies were misleading because they failed to account for the fees that were charged to participants in the program, which the CFPB found ordinarily exceeded any savings. And in one case, the CFPB also found that the company had no basis for its advertised claim to have helped hundreds of thousands of consumers save $29 million. The companies were ordered to pay $7.5 million and $9.3 million in redress, respectively, but the bulk of those amounts were suspended due to an inability to pay, and each company was also required to pay a $1 civil money penalty, which serves to allow harmed consumers to be reimbursed from the CFPB's civil penalty fund. The CFPB also settled with one of the nation's largest mortgage servicers, along with the attorneys general and bank regulators from all 50 states, Washington, D.C., and several territories. In that action, the CFPB alleged that the mortgage servicer failed to honor borrowers' loan modification agreements, foreclosed on borrowers whom it had promised to not foreclose on while their loan modification applications were pending, improperly increased borrowers' permanent modified monthly payments, and improperly handled private mortgage insurance and escrow accounts. The settlement requires the company to pay $73 million in redress and a $1.5 million civil money penalty to the CFPB. We expect mortgage servicing, and in particular how servicers treat consumers impacted by COVID, to be a priority of the CFPBs in the coming years, as we discussed. In late December, the CFPB settled with a student loan servicer for violations of a prior CFPB consent order regarding misstatements of amounts due on billing statements. The CFPB found that the servicer violated the order both by continuing to misrepresent amounts due and by failing to provide all of the redress that the prior consent order had required. And the servicer was ordered to pay at least $10 million in consumer redress and a $25 million civil money penalty. And this is the latest in a series of actions that the CFPB has brought for violations of prior consent orders. Two additional enforcement actions brought under Director Kraninger warrant mention because they both involved instances in which the CFPB alleged that a state law licensing violation constituted a federal UDAP claim. The first case involved a debt collector who used unlicensed debt collectors in states that required a license to collect debts through the judicial process. And the CFPB found that when these individuals threatened to sue or did sue to collect debts, they implicitly misrepresented to consumers that they had the legally enforceable right to sue, which they did not have because they lacked a license. And so the CFPB found this to be a deceptive practice under federal UDAP law. The second case involved a mortgage lender who used unlicensed mortgage originators. And the CFPB found that when these employees performed tasks that require licensing, quote, they caused consumers reasonably to believe that the employees were legally authorized to do those things when in fact they were not legally authorized, end quote, and that consumers might have acted differently, including taking their business elsewhere if they had known the truth. And so that also the CFPB found was a deceptive action under federal law. In both of these cases, there were other federal laws that expressly prohibited the practice at issue. The FDCPA prohibits debt collectors from taking actions that can't legally be taken, and Regulation Z requires mortgage loan originators to be licensed. But the CFPB still decided to bring a deception claim in each case, presumably because it wanted to establish a precedent that it can point to later, because these additional claims didn't lead to any additional or different remedies, so we can't think of another reason to assert those claims. And we do expect this kind of creative interpretation of the CFPB's authorities to continue under Director Chopra. And speaking of Director Chopra, we wanted to touch base briefly on what we can expect from him in terms of his enforcement approach. And based on his writings while a commissioner at the FTC and his statements at the confirmation hearing, there are several key themes to highlight. First, as we discussed, is this focus on monetary remedies in all enforcement cases. Second is a focus on large companies. Commissioner Chopra has repeatedly commented about how it is important that regulators do not give large companies a pass, but instead aggressively pursue them in enforcement. And third is a willingness to take creative legal positions that expand the agency's authorities, along with a willingness to litigate to vindicate those positions. Commissioner Chopra has written often about how an agency should use all of the tools that Congress gave it, and that litigation is important to help establish good precedent. Taken together, we read that as a willingness to be creative, even if it means losing some cases. Finally, we wanted to briefly flag the two enforcement actions that have been filed under Acting Director Uejio's leadership, both of which are contested lawsuits. The first was a lawsuit against a company that served as an intermediary between immigration detainees and the sureties and bond agents who post immigration bonds, resulting in the consumer's release from detention. The complaint contains pretty harsh factual allegations about the defendant's conduct and alleged misrepresentation. But what's most notable about the case is that it doesn't actually involve a consumer financial product or service, which is what the Bureau's jurisdiction is limited to. Instead, the CFPB alleges that because the defendant allegedly misrepresented to consumers that the defendant itself paid for the immigration bonds, which it did not, that consumers understood the monthly fee payments they were making to be loan payments, which they were not. So that is, the CFPB alleges that because the defendants led consumers to believe that the company was offering a consumer product or service, the defendant's conduct is subject to the CFPB's authority, even though they weren't actually offering a consumer financial product or service. This is a prime example of the kind of creative and forward-leaning interpretation of its authority that we think we can expect from the CFPB going forward. And notably, this investigation had been pending for years, and so it appears that there might have been some hesitation to bringing it under Director Kraninger's leadership. I think it's also interesting to note that the CFPB's press release about the case casts it as a matter of racial equity, suggesting that the agency's focus on racial equity that Stephanie talked about may extend more broadly than just enforcing the Equal Credit Opportunity Act. The second lawsuit that the acting director brought was against the payment processor and its owner, alleging that the defendants processed tens of millions of dollars in remotely created checks for companies that had allegedly defrauded elderly consumers by misrepresenting the services they were selling. And the complaint alleges that the companies continued to process these payments despite being aware of nearly 1,000 consumer complaints and inquiries from police departments around the country. The two prior cases the CFPB has brought against payment processors resulted in dismissal of the CFPB's claims. In one case, that was a sanction for a discovery violation. In another, it was court granted a motion to dismiss. It'll be interesting to see if this latest lawsuit fares any better. And lastly, it's worth noting that in both of these cases that have been brought since the inauguration, the CFPB's press releases have reverted back to their tone from years past, aggressively describing the underlying conduct alleged to have occurred and returning to the CFPB's use of words such as scam in describing that conduct, words that had not been part of the Bureau's enforcement press release lexicon under Directors McMulvaney or Kraninger. And with that, I will turn it back over to Stephanie.
Okay, so let's turn to rulemaking. On the regulatory front, we know the CFPB is already revisiting a couple of its previously issued rules. So they announced at the end of February that the Bureau plans to propose a rule to delay the mandatory compliance date of the general qualified mortgage rule from July 1st of this year to October 1st of 2022. And the statement that they issued suggests that this extension would allow lenders more time to make QM loans that are based on a borrower's debt-to-income ratio or based on the fact that they're eligible for purchase by Fannie or Freddie and not solely based on a pricing cutoff. And the purpose of this really, they're saying, is to ensure that lenders and homeowners have maximum flexibility and options during the pandemic. So if a notice of proposed rulemaking is ultimately finalized as proposed, the old DTI-based general QM definition, the new price-based general QM definition, and the GSE patch would all remain available as long as the lender received the consumer's application prior to October 1st, 2022. And they also hinted that they may revisit the seasoned QM rule. Separately, in the payday lending space, the new director could make it a priority to revise the 2020 rule on short-term lending in order to reincorporate the mandatory underwriting provisions from the 2017 version of that rule. And the Bureau is in the midst of lawsuits challenging both of the major aspects of the payday rule, the underwriting provision that had been repealed and the collection provisions that remain intact. So it's pretty clear CFPB will vigorously defend the industry lawsuit challenging the collection provisions, but it's less clear how they're going to handle the lawsuit that challenges the repeal of the underwriting provisions. We would presume that under new leadership, the CFPB would like to reinstate those ability to repay provisions or something like them. So we'll see what happens with that lawsuit. It may be a way for the Bureau to try and repeal the repeal, so to speak, of the underwriting provisions. Another rule that might be revisited is the debt collection rulemaking from October, which we reported on in one of our previous calls at the end of last year. That rule drew some criticism from consumer advocates for not being restrictive enough in terms of its regulation of consumer communications. So it's possible the Bureau could decide to take another look at that, and they might also take on rulemaking governing first-party debt collection, which wasn't covered by that rule. There are some recently promulgated rules that we think are not likely to change. They'll probably stand as they are, even though new leadership wouldn't necessarily have been as supportive of their drafting. One is the final rule that the Bureau issued in January regarding the Bureau's use of supervisory guidance. This rule codified the Bureau's earlier statements that clarified that guidance does not have the force and effect of law, and that indicated that the Bureau doesn't take enforcement actions or issue supervisory criticisms that are based on non-compliance with supervisory guidance. And I say that we think those will probably stand because Mr. Chopra was specifically asked about this in his nomination hearing, and he replied that guidance cannot impose obligations and that guidance is not the appropriate process by which new laws are created. So, if he's true to what he said in his testimony, it seems he wouldn't likely act to change that rule. The other one that comes to mind is the Bureau's October amendments to its confidentiality rules. The Bureau had made some changes to those provisions, one of the most noteworthy being that they had added a provision that clearly allows the recipient of a civil investigative demand to disclose that it's the target of an investigation. And with that amendment, CID recipients no longer have to worry about whether notifying insurance companies and contractual counterparties and investors, et cetera, would be a violation of the CFPB rules. So they're now free to disclose or not as they see fit. There are also several rules in progress. We expect to see new leadership continue to move these forward. One, of course, is the Section 1071 Small Business Data Collection Rule. We've talked about this before. The CFPB finally started to make some progress there in 2020. Another is the Section 1033 Consumer Access to Financial Records Rule. The CFPB issued an advance notice of proposed rulemaking on that topic in October. And we'd expect to see a future proposal that will seek to balance consumer convenience against privacy and security concerns. Lastly, just earlier this week, the Bureau issued an interpretive rule to clarify that the Equal Credit Opportunity Act's prohibition against sex discrimination prohibits discrimination based on sexual orientation and gender identity. And this rule, of course, was anticipated. It follows on HUD's recent pronouncement that it, too, would construe sex discrimination under the Fair Housing Act to encompass sexual orientation and/or gender identity discrimination. And these two positions from HUD and CFPB result directly from the Supreme Court's decision in Bostock versus Clayton County last June, which construed sex discrimination under Title VII of the Civil Rights Act, which prohibits workplace discrimination accordingly to prohibit against discrimination for sexual orientation and gender identity. Turning to supervision and guidance, there are a couple of developments on that front. We can expect the CFPB to remain focused in the near term on consumer harms relating to the COVID-19 pandemic. As we've heard repeatedly from the acting director, that's his #1 priority. And the Bureau issued a special edition of its supervisory highlights publication in January, in which it talked about findings from its prioritized assessments of supervised institutions. So these prioritized assessments were those targeted exams that the Bureau conducted in markets where they felt there were elevated risks of consumer harm because of the pandemic. So, for example, they covered areas where the CFPB thought that risks were high for consumers who had trouble making loan payments because of lost jobs or income. So we're talking about servicing of mortgages, auto loans, student loans, and so forth. And as part of the process, the Bureau sent closeout letters to entities with some supervisory recommendations, and they said that they're going to be following up on the risks that they identified through the normal course of supervisory work. Among other things, with respect to mortgage servicers, they found that some provided either incomplete or inaccurate information about forbearance, that auto servicers allegedly provided imprecise information about the impact of interest accrual during deferment periods on the final loan payment amount, and student loan servicers allegedly failed to routinely discuss all available repayment options with borrowers. So these and other practices also might have negatively impacted a consumer's credit report. So, one of the other focuses coming out of those prioritized assessments is going to be credit reporting. And then one last thing I want to touch on before I turn it back to Ori to talk about innovation is a guidance document that the Bureau issued in January. This is an official guidance statement relating to providing financial products and services to consumers with limited English proficiency. This was one of Director Kraninger's last actions in office. It's an area where there's been a lot of regulatory uncertainty. LEP was one of the most commented on topics from the Bureau's ECOA request for information. And the statement provides 5 general principles. They're basically encouraging financial institutions to serve LEP consumers. They suggest developing pilot programs or other phased approaches. They talk about providing clear and timely disclosures, describing the extent and any limits of language services that are provided. And then they go on to provide some more concrete guidelines for how to implement these general principles and how to develop compliance solutions. In general, the guidelines on LEP give financial institutions some leeway to decide what makes the most sense for them, given their own customer base, with somewhat of a focus on trying to make your decisions based on where is the greatest need for the consumer, what's sort of the most important terms and conditions type documents that are going to be the most important to the consumer. So it's somewhat common sense, but I think it is helpful for financial institutions who are concerned about how to serve LEP consumers in compliance with ECOA and UDAP prohibitions. Okay, I'll stop there and I'll turn it back to Ori because I know there have been some recent developments on the innovation initiatives.
Thanks, Stephanie. Yeah, we've seen several important innovation developments since last fall. And the CFPB's innovation toolkit, as it were, consists of a no action letter policy, what's called a compliance sandbox, and a new advisory opinion policy. And we've seen increased attention in all 3 areas under Director Kraninger. And this might be one area where Director Kraninger's policies are carried over into the new administration. With respect to no action letters, last fall the CFPB issued a no action letter to a major bank regarding its small credit product. The letter was based on a template that the CFPB had previously approved, and it states, as all no action letters do, that the CFPB will not take enforcement action or supervisory action against the bank for offering the product, which in this case includes credit up to $500, a flat fee of $5, and an APR not to exceed 36%. And the product's limited to the bank's checking account customers, so the bank does have a right of set-off against those accounts. Payment terms are 3 months, and no rollovers would be permitted. And these are all terms that are consistent with this template no action letter the CFPB issued, which is basically a way of encouraging companies to apply for an actual no action letter that would apply to their specific product. The Bureau also issued a no action letter to an online lender for the use of artificial intelligence and alternative data in underwriting and pricing unsecured closed-end loans. And this letter was issued to a company that had previously gotten a letter in 2017. So the new no action letter renews this for another 3 years and states the Bureau won't bring action under either the Equal Credit Opportunity Act or for UDAP violations for use of the automated tool. the letter does require the lender to adopt what is called a model risk assessment plan to test the model for potential fair lending concerns and to provide the CFPB with certain related data. At the end of last year, the CFPB also issued its first 2 approval orders under the Compliance Assistance Sandbox that the agency had announced in the fall of 2019. One approval order was for a dual feature credit card that was designed for consumers with limited or damaged credit histories and is intended to allow them to reestablish a favorable credit history. So the card starts out as a secured credit card with an option for the account holder to graduate into an unsecured card after 12 months. And what the approval order does is it provides a safe harbor to the company from liability under certain provisions of TILA and Regulation Z that relate to the combined disclosures that are going to be issued to consumers, sort of disclosures both for the secured card feature and the unsecured card feature, and for the change in APR that would be associated with that shift in card type. The second approval order was issued for an earned wage access product, and that's a means by which consumers can access the wages that they've earned prior to payday. And the order affirms the CFPB's determination that this product, under the circumstances described, doesn't constitute credit under TILA and Reg Z, and therefore it provides the provider of the product, again, with a safe harbor from TILA liability because of the Bureau's interpretation. And lastly, the CFPB also launched an advisory opinion program in the fall, and it issued its first 2 advisory opinions. The first one, like the approval order, concerned earned wage access products generally. And it provides that where certain criteria are met, including that the amount of the transaction, the amount of money the consumer can get, doesn't exceed the accrued cash value of wages that have been earned, and that there's no recourse against the employee if repayment is via payroll deduction fails, that under those circumstances, such products don't constitute credit under TILA and Regulation Z. And so that provides liability protection for companies that act in good faith conformity with the advisory opinion. And the second advisory opinion set out the CFPB's interpretation of the phrase private education loan in TILA and Reg Z, and it concludes that that term includes consolidation loans that consolidate federal education loans. So even though the consolidation loans themselves aren't made for the purposes of paying college expenses, the CFPB concluded that they still qualify as private education loans under TILA and therefore are subject to certain special provisions of TILA and Regulation Z. Taken together, we think the issuance of 2 no action letters, 2 approval orders, the advisory opinion policy, and then 2 advisory opinions, those all represent the most concerted set of actions we've seen to date regarding innovation since the CFPB's establishment. They seem to be generally consumer protective actions, and I think in light of the consumer protective features of the product that were the subject of these actions, they may help to demonstrate the utility of these programs, both in terms of providing clarity to the market and also in encouraging the offering of innovative products and services. So it's obviously only time will tell whether Director Chopra continues these programs, which didn't really take off under Director Cordray, but they certainly seem to have momentum now. And as we said, they may well be the one part of Director Kraninger's legacy that continues into the future. So that's all we had for you today. Thank you to everyone for tuning in. Just a few brief reminders. You will receive an email with a link to the recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. And lastly, as mentioned before, if you have any questions related to today's content, please email them to gfm@mayorbrown.com. Thank you again for your participation. You may all now disconnect.